Welcome to our outlook for 2023. Before we start with our projections of 2023, it would be good to take a look back at the year 2022. While we are not going to discuss two in full detail, that we will do in our Paisa Vasool volume, which would hit in the first week of January, we will discuss in brief as to the key events that shaped the year. In 2022, we saw a grim global picture led by United States of America. The year started with COVID and soon followed by the war in Ukraine. This led to global supply constraints and ultimately inflation, which became a huge global problem. And a lot of energy of Fed and other central banks across the globe were focused towards tackling inflation. As a result, what we saw was a that was happening in US stock markets and elsewhere came to a standstill in the year 2022. US stocks in particular beaten because of extraordinary rise in interest rates in US. Dow Jones fell by 8.6%, S&P 500 by 19.35%, and Nasdaq was the main culprit as it fell by close to 33% in the calendar year 2022, which is a significant downfall in the context of the markets. Elsewhere in the world, picture was the same or worse, particularly in China, which to our mind is the biggest black hole globally. We don't really know what's coming out of China, whether we should be trusting the data that comes out of China, whether it is manipulated, whether it is good, bad, ugly, we don't really know. However, whatever little we saw out of China was not good at all. The numbers in what we also saw was the coronation of President Xi for the record third time. And as we have seen, his priorities are more socially inclined and politically inclined rather than economically. As a result, we saw a huge amount of exodus of FIs happening from China, and a lot of other countries are eating into that space. The economic policies in China are not really favorable to a lot of FIs. As a result, China, which is the powerhouse of manufacturing across the globe, is witnessing an increased number of manufacturing outflows happening from the country. This also led to, in some ways, constraints of global supply along with whatever happened in Russia and Ukraine. So at this point of time, when we are talking, China is facing a big COVID crisis, perhaps for the first time in last 3 years. The country from where COVID originated had escaped the clutches of COVID till now. But what we are seeing at this point of time is that COVID has resurfaced or surfaced for the first time in UK. The data cannot be relied on, but whatever we are seeing in US is in China is not good at all. We have to be particularly wary as to what happens over there. It's a big black hole, and we are not really sure as to what is really going to transpire in China, or is it the way we used to do in the past. Elsewhere in Europe, the story was even worse. We can safely conclude that Europe is in a grip of recession. It is one continent which has been badly impacted by the war in Russia and Ukraine. To Russian gas and energy in particular, to countries in Europe has taken its toll. A lot of influrge in the world particularly in Europe, is really having a catastrophic effect. And as a result, we are seeing a recession on its doorstep, and most particularly will have a severe impact going forward in Europe. In UK, the situation was not different. What we saw in UK was a political turmoil wherein the prime ministers were coming and going. As a result, economy suffered big time because of indecisiveness and perhaps in some cases even not so good decisions which were taking um, coming in and out. So let's take a look at some of the numbers. In US, the chief benchmark index, which is the technology index, is Nasdaq. It fell by a whopping 35% in last 1 year, in the calendar year 2022. And this is very meaningful, which means that all stocks, technology stocks, fell by almost one third its value. And some of the leading stocks actually corrected far more. Perhaps the impact on the individual stocks in their portfolio, technology stocks, was even more. Russell 2000 was, it fell by almost 20%. S&P 500 was down 20%, and Dow Jones fell by almost 8%. Now these are quite big negative numbers and not small at all. And this is happening when the economy is not really as flat or negative as people are assuming very well. Yet the benchmark indices have not done too well, perhaps fearing that interest rates rise would take its toll on economy at some point of time, which is the German index and French index, CAC, both fell by 11% and 8% respectively. Surprisingly, even though things were really bad in UK, overall the UK index, the main benchmark index, FTSE 100, rose by 1.35%. But let's not get colored by the performance of the index, and we really believe that UK economy didn't do as well as it should have done. In Asia, in a lot of countries, coming back from actually a low base, Hang Seng was down 15.5%, and it could have been worse, except for the fact that in last 1 month it rose by almost 20%, and yet down by 15.5% shows extreme turbulence in Chinese economy. Shanghai was down 16.4% for the year. Taiwan was down 20% for the year, whereas Nikkei in Japan was down 9%. Straight Time Index in Singapore was perhaps the best performing index in the eastern side of the globe, and it rose by 5.2%. But I mean, we can't read too much out of whatever happened in Singapore because it's a small country. It does have its role, but overall, the impact on global economy is little. Look, and if we come back to India, and India seems to be the biggest, the brightest shining star in the global economy. Despite its recent fall, India impressed right throughout the year. There were structural reforms happening in India in a big way. Digitization, the demography changes that have happened in India is playing its part, and adopt new technology. All this is playing its part. India has low debt to GDP. Credit offtake is happening in a big way. The bank balance sheets have cleaned substantially, and it's aiding the growth in a big way. There's a manufacturing shift happening in India. Government of India is also emphasizing on important sectors like manufacturing, which also generate huge amount of employment. There's tremendous amount of focus on infrastructure, and we are seeing highways getting built at almost 40 kilometers per day speed, which has never been seen before, connecting itself in a big way. and a lot of positives are emerging out of India. There's political stability, jump in revenue collections, which is also helping the ruling establishment maintain its economic and social priorities in balance, and is a great interest in Indian markets by foreign institutional investors, despite FIs actually withdrawing from India in some ways in 2022. Yet whenever we talk to institutional investors, we see greater amount of interest. India is generating truly a buzzing place in 2022. Now, we saw a fall towards the end of calendar year 2022, but it originated more from the selling of HNI investors. On the basis of performance of last few days, judge the performance of India. Having said that, the last 1 year was actually pretty good for India in the global context. When the other economies were not doing so well, India has done fairly remarkably well, and we should give full marks to India for doing what it is doing at this point of time. So, despite the numbers and see how the benchmark index is performed, we would see that Nifty was, despite whatever the buzz that was getting generated, Nifty was flat at 2.61% positive performance. Nifty Bank was the outlier with almost an 18% positive performance. Mid cap was down 1%, which performance. An index that really took a beating was the Nifty Small Cap Index, which was down almost 19%. So, in a nutshell, we can say that the the large cap index was flat. The banking sector did exceptionally well, and it's the small cap index which bore the brunt. Now, uh, where it takes us, what is the meaning of all this? Where do we stand? What is the present? We've spoken of the past. We need to look at the present. What are the valuations? So, if you look at Nifty 50, the PE multiple of Nifty 50 is about 21.4. The EPS of Nifty 50 is around 832, which translates into price earning multiple of 21.4. Price to book value is about 4.2. And if we look at the global context, the relative fundamental performance of India, we can see that probably it's a little expensive at this point of time. Future, uh, why we are still bullish on Nifty 50, despite the fact that it is a little expensive, we have reasons to believe that, and we'll talk about it. Nifty Bank is trading at a book value of 2.8, and it is reasonably valued. Yet we feel that whatever is happening in the Indian banking sector in terms of cleaning up of the books and the credit offtake taking place, we are extremely bullish on Indian bank in particular, and we feel that there is a lot more to come in terms of gains for shareholders in the banking space in times to come. We'll talk about that again later. So, from fundamental perspective, it's reasonably valued at 2.8 times the book value. Um, this year, public sector banks have done extremely well. Yet they're trading at less than or one times the book value, and still makes them attractive along with the private banks. Overall, we remain bullish on the banking space in 23 and perhaps in the years thereafter to come. The Nifty mid cap is at a price earning multiple of 23, which we believe is undervalued. Historically, it's been between 20 to 100 odd levels, and we are at the lower band of this, and there's money to be made in the mid cap segment, and but you have to be quality conscious over there, and we'll talk more about it in few minutes. Nifty small cap index, as we said, was down by almost close to 20 odd percent, being at a price earning multiple of 15.76, which is all-time low levels. Given the earnings in the Indian context have done, Basis that we are reasonably sure that it is strongly undervalued at a price earning multiple of 15.76 and a price to book multiple of 2.8. So, what is the future outlook? Since we are long term investors, we believe in long term theory, and we believe that 1 year is not really, or let's say, time frame is not really the time frame that we should be looking at when we are investing into equity markets. So, I'll try to give you our outlook for the year 23 and beyond, especially in the Indian context. So we strongly believe that India will continue to shine globally, and this could very well turn out to be India's decade. And I'm not just bullish on India in terms of a 1 year or a 10-year time frame, maybe much more than that over a period of 20 years. And probably at the worst, what could happen is perhaps some self goals that may happen as a political party, another political party coming to India with, you know, reverse ideology, not really in favor of it, reforms that are happening, some U-turns on political policy, wars, pandemics, but those are things which are unpredictable. I think the forces that are shaping India, like demography, digitalization, are irreversible. And no matter what happens over a longish period of time, there could be hiccups in between because of such ideologies or such U-turns, but it's not really going to impact India meaningfully over a longer period of time. And I really think that India is will outshine its peers, will continue to do extremely well. Corporate earnings are going to be extremely good. We believe that they may grow by almost 50% in the year 2023, and in the range of 15 to 20% for next 2 to 3 years. So we also feel that the elections due at the center in the year 2024, and if we believe that the current establishment comes back to power in 2024, we will witness an unleashing of structural reforms that have never been seen before. FIs, particularly FDIs, would be eyeing India in a big way, and a lot of large institutions, long-term institutions, FIs could be both short-term, long-term, but a lot of institutional money which is geared towards the long-term investments would flow into India in a very substantial way. Um, the great Indian middle class is another thing which will gain a huge amount of attraction globally. It's a huge population, and a portion of the upper middle class is moving towards the rich class. The class shift is happening in India. The lower class is becoming perhaps lower middle is becoming middle is becoming upper middle, and upper middle is becoming rich, and rich class is swelling in a very significant way, and that certainly is attracting global attention. The buzz is really there. We see that this class shift will drive the consumption as well as the demand for luxury products in a very strong way. We'll see all kinds of brands eyeing India substantially. Maybe Tesla might rue its fact that as of now it has not really entered India. They might just come to India, and also agreeing to the conditions set by Indian government. So that's what going to happen in India in a very substantial, meaningful way in years to come, or perhaps in 2023 itself. In 2023, we may also see the interest rates, the rise in interest rates which RBI is undertaking at this point of time will pause, perhaps in January, and thereafter towards the second quarter and thereafter interest rates being cut in India to aid growth, and this would only benefit Indian corporates and Indian economy in a big way. So It's very difficult to predict how markets will shape up in 2023. I usually refrain from giving short-term predictions, but even if somebody Indian markets will perform in the year 23, I would say that Nifty will probably rise by 5 to 10% and around 15 odd percent over next 5 years. Which means that probably your money will more than double in next 5 years. Bank Nifty is, I'm very sure that it's going to do very, very well. Not from a short-term frame of mind, not a short-term, not from a short-term perspective, but from a very, very long-term perspective. Even in 2023, we feel that it might just grow by 15 to 20%. The Nifty Bank Index is likely to grow by 15 to 20% in 2023 and around 20% over next 5 years. Nifty Mid Cap Index, which we feel is undervalued, may grow by 15% in 23 and around 15 to 20% over next 5 years. And Nifty Small Cap may grow by 20 to 25% in 23. There could be, a huge amount of turnaround in Nifty Index. In Nifty Small Cap Index, we've generally seen that in the past, wherein the small caps tend to outperform after the performance comes in large caps and mid caps. So small caps there might be a vengeance rally happening in 2023, and we feel that in next 5 years the small cap index would perhaps rise by 20%. So bottom line is invest in India in a big way and enjoy the growth that's happening over here in next few years. It's a huge opportunity. Don't miss out on the equity markets. Just keep in mind that you're not breaching the asset allocation based on your risk profile, and invest accordingly. If your equity asset allocation is more than what is desired, just shave off some percentage from that allocation. If you're under allocated in equities, add more with every fall. Coming back to US, we feel that focus will shift from fight against inflation to fight against stagnation of economy, and there would be a reversal of Fed policy. Inflation would be a forgotten word, and the buzzword would be growth, as because of the current steps that the Fed is taking, there would be slowdown in US economy, and next year everyone would be worrying and talking about the growth in US economy. As a result, corporate America will feel the pinch and of tightening, and earnings will corporate earnings will grow around 5 odd percent. Stock markets will, however, rebound because there was such massively poor performance in 2022. So they're relatively sitting on a low base, and from here, probably there would be a rebound in US stocks, particularly the worst hit NASDAQ, and we can see a rebound happening in the technology stocks in US. So we feel that NASDAQ will gain around 15 to 20% in 2023, Russell by 10 to 15%, S&P 500 by 10 to 15%, and Dow Jones by 15%. So Europe, we remain apprehensive about Europe. We feel it will be in deep recession in 2023. War will probably end, but it will have dramatic consequences on Europe overall. We may see a recovery towards the fag end of 2023, but overall it's best to avoid Europe at this point of time, and we will reevaluate towards the end of 2023 as to what we need to do next. In China, COVID wave is likely to intensify in the first quarter. Economy will stay in turmoil. There would be political rise and probably shifting of manufacturing and other things happening out of China, and everyone will be looking at, as we are talking of, whatever we're talking of is the China plus one theme, and hence a lot of other countries come into contention. So our advice would be to don't increase allocations into China, but hold on to whatever you have because of last 1 to 2 years of sheer underperformance. It may bounce back, but with all the turmoil, it's not really worth it. So hold on to allocations, don't increase allocations. But at the same time, some of the neighboring Chinese countries like Korea, Japan, and Taiwan look extremely attractive. They have and Indonesia, and they have structures in place wherein the economy should do extremely well and sitting on 1 year of underperformance, and hence they might rebound, and one can look at these countries for investment in the year 2023. So overall, our assessment is a good 2023. India will attract global attention. We remain constructive on India and some of the other countries, emerging countries that I've just spoken about. US will uh, rebound in some ways, but that would be on the stock market basis, but perhaps not so economically, and focus will shift more on the fight on growth rather than fight on inflation. China will remain a black hole, and West to avoid, Europe again to avoid because of reasons. I wish all the investors a very, very happy and prosperous 2023. May you make a lot of money. But as I always say, there has to be a method in madness. Stay true to the basics. Think long term. Don't invest in companies because your fellow investors are investing into it. Don't speculate. It's hard earned money. Don't gamble. Um, there is money to be made in equity markets only if you think the right way. So, all the very best.